wherever you are and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest developments in the global financial markets. And we do that by first giving you a broad overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 212, and in this episode we're reviewing the performance of the financial markets during the 19th week of 2026, and that is from Monday the 11th to Friday the 15th of May. And without further ado, this is your host Jamuhuri, and together let's dive right in. We kick it off in the United States, where the prices that consumers pay for a wide range of goods and services increased at a faster than expected pace in the month of April, as another surge in energy prices raised further concerns about the impact of inflation on the U.S. economy. According to the Bureau of Labor Statistics, the headline rate of inflation, as measured by the Consumer Price Index, rose at a seasonally adjusted monthly rate of 0.6%, whilst the annual rate came out at 3.8%, which was 0.5 percentage points higher than the previous month of March, and was also the highest rate recorded since May 2023. Excluding food and energy prices, the core consumer price index increased at an annual rate of 2.8%, which means that inflation remains well above the Federal Reserve's target rate of 2%. Please note that the Fed considers core inflation as a better indicator of longer-term inflation trends. This latest inflation data comes at a crossroads for the Federal Reserve, which has kept its benchmark interest rate on hold since the beginning of this year. And at the same time, the incoming chairman, Kevin Walsh, who has advocated for lower interest rates, will find himself in a difficult position as the conflict between the US and Iran continues to drive up energy prices and consequently the rate of inflation in the United States. On Wall Street this past week, stocks fell on Friday, bogged down by losses in technology stocks and a rise in U.S. Treasury yields after a summit between President Trump and Chinese President Xi Jinping ended without any major policy breakthrough, as investors took profits in tech stocks after the sectors saw sharp gains recently. Stocks have been on a record-breaking tear on a renewed fervor around artificial intelligence. Market players believe that sentiment among investors remains very optimistic. However, a deeper analysis shows that the broader market is lagging the largest tech companies, and this is creating a divergence that suggests that the current stock market rally may soon run out of steam. Thursday marked a winning session for the major indices, with the Dow reclaiming the 50,000 level and the S&P 500 closing above 7,500 for the first time ever. On Friday, the S&P 500 shed 1.24% to end at 7,408, whilst the Nasdaq Composite slipped by 1.54% to close at 26,225, and the Dow Jones Industrial Average was down by 537 points to settle at 49,526. In the bond market, U.S. Treasury yields spiked on Friday following a week of messy inflation data and as traders looked to predict the future of interest rate policy under a new Federal Reserve chairman by the name of Kevin Warsh. The jump in yields comes as Kevin Warsh, who was confirmed by the Senate on Wednesday, grapples with an increasingly complicated inflation picture. President Trump, meanwhile, continues to push for lower interest rates, even as the latest inflation data shows consumer prices ticking higher. Reports this week showed the consumer price index inflation rate at 3.8%, which was the highest level since May 2023, and similarly producer prices, which measure inflation at the producer level and signals pipeline inflation. This came in at an annual rate of 6%, which was the highest rate since late 2022. The yield on the 2-year Treasury note, which tends to react in line with short-term Fed rate decisions, was higher by about 9 basis points to settle at 4.079%, whilst the yield on the benchmark 10-year Treasury note, which is the main benchmark for U.S. mortgages, this increased by nearly 14 basis points to close at 4.595%. For your information, 1 basis point is equal to 0.01%, and bond yields and prices move inversely to one another, which means that as interest rates rise, bond prices fall, and vice versa. In the commodity markets, oil prices rose on Friday as President Trump is now expected to turn his attention back to the conflict with Iran after the summit in China with President Xi Jinping failed to deliver any major policy breakthroughs. In its monthly update, the International Energy Agency has warned that global oil inventories continue to decline at a record pace in line with the supply disruptions in the Middle East and will approach critical levels if the Strait of Hormuz does not reopen before peak demand during the summer. The oil market has not felt the full impact of the supply loss, thanks to commercial inventories held by industries and strategic reserves controlled by governments, as well as oil tankers in transit. In response to the foregoing, the price of the international benchmark Brent crude gained more than 3% to close at $109.26 a barrel, whilst the price of the U.S. benchmark, that is West Texas Intermediate crude, advanced more than 4% to settle at $105.42 per barrel. In the precious metals market, gold fell to more than a one-week low on Friday as U.S. Treasuries and the dollar climbed, while heightened inflation concerns due to the conflict in the Middle East reinforced expectations for higher interest rates. Crude oil prices have risen more than 40% since the war against Iran began, leading to higher inflation across the globe. Meanwhile, central banks tend to hike interest rates during times of inflation, which in turn tends to dim the appeal for gold, which is a non-yielding asset. The yield on the benchmark 10-year Treasury bond rose to near one-year highs, increasing the opportunity cost of holding a non-yielding asset such as gold. Meanwhile, the dollar was set for its highest weekly gain in 2 months, making gold more expensive for overseas buyers. The price of spot gold was down more than 3% this past week and was last seen trading at $4,556 per ounce, which is its lowest level since the 5th of May. And in related news, Prime Minister Narendra Modi has urged citizens to reduce the purchase of gold for the next 1 year as demand for bullion continues to put pressure on the Indian rupee. In this regard, the Indian government has imposed a 10% basic customs duty and a 5% tax on gold and silver imports, raising the import duty on gold and silver to 15%. India is the second largest consumer of gold in the world, and according to a recent World Gold Council report, India's monthly average of gold imports rose to 83 tons in the first 2 months of 2026. However, this demand for gold is inflating the country's import bill, which is already under pressure due to supply disruptions in the Middle East and the subsequent increase in global energy prices. The combination of these two factors is expected to significantly widen India's current account deficit, leading to a weakening of the Indian rupee against the US dollar. In the cryptocurrency market, the crypto market lost nearly $90 billion in market capitalization in a single hour on the 16th of May, pushing Bitcoin down to below $78,000 and triggering mass liquidations across the board. This particular sell-off was not crypto-specific, but was rather driven by a macro repricing event that spilled across global risk assets. According to the latest inflation data, the Consumer Price Index for the month of April came out at 3.8%, whilst the Producer Price Index, which measures wholesale inflation, came out much higher than expected at 6%. This back-to-back inflation report effectively ended any expectations for the Federal Reserve to cut interest rates, with the CME's Fed Watch tool showing more than a 44% probability for a rate hike by December this year. And on that note, we now change scene to the Kenyan financial markets. And we start by looking at the domestic foreign exchange market, where the Kenya shilling slipped marginally versus the US dollar this past week. And according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at 129.33 compared to a rate of 129.19 that was recorded the previous week. Meanwhile, the sterling pound was priced at 174.69 and the euro was valued at 151.24. And on the regional front, one Kenya shilling was changing hands for 28.91 Ugandan shillings and 20.06 Tanzanian shillings, and to the Rwandese franc, it was posted at 11.31. The International Monetary Fund has previously raised concerns about the extreme stability of the Kenya shilling, but the central bank continues to insist that it operates a floating exchange rate policy. However, the data tells a different story, as the dollar shilling rate has been stuck at between 129 to 130 shillings over the past 2 years and now appears to be operating like a fixed exchange rate. Given this previous price action and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenya shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product and consumes about 65% of total revenue collections. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves increased for the second week in a row, and this time by around $93 million for a grand total of $13.50 billion, which is equivalent to 5.7 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this relatively massive position, Kenya's foreign exchange reserves still remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. On foreign exchange remittances, the inflow of remittances to Kenya in April 2026 totaled to $397 million, and this is compared to $421 million that was received in March 2026, which was a month-on-month decline of 11.7%. However, the cumulative inflows for the 12 months to April 2026, this increased by 1.1% to $5.05 billion, and this is compared to an amount of $4.99 billion that was recorded over the corresponding period in 2025. The inflow of remittances remains a key source of foreign exchange earnings for the country and continues to support the balance of payments as well as the domestic foreign exchange market. In the money markets, during the past week, the interbank market remained sufficiently liquid and was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The overnight interbank rate, which is now referred to as the Kenya shilling overnight interbank average, aka KESONIA, this is the rate that banks use to lend to each other and is now the new reference rate for lending transactions by commercial banks. The overnight interbank rate remained unchanged at 8.75%, which is in line with the central bank rate at the same rate of 8.75%. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio that is currently set at 3.25%, this averaged at around 27.3 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 14th of May, and the central bank received bids totaling to 26.4 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 110%. The central bank accepted almost the entire amount offered, and the results of the auction were as follows. The 91-day rate increased by about 12 basis points to settle at 8.31%, whilst the 182-day rate was flat for the second week in a row at 8.21%, and the 364-day rate ticked up marginally by about 5 basis points for a weighted average rate of 8.56%. Over the past 3 weeks, the Treasury bill market appears to be reversing its previous downward trend, and this is on the back of the first supplementary budget for 2025-2026, which pointed to a massive increase in the domestic borrowing target of about 360 billion shillings. In addition to that, the latest data shows that inflation is now trending higher, mainly due to the impact of rising fuel prices. As a result, we should therefore expect more upward pressure on interest rates as investors park their funds into the 91-day Treasury bill, which gives them an opportunity to reinvest at a higher rate in the short term. In the primary bond market, the Central Bank of Kenya, acting in its capacity as fiscal agent for the Republic of Kenya, has published a prospectus for the reopening of 2 fixed coupon treasury bonds in which it is looking to raise a total of 50 billion shillings for the stated purpose of budgetary support, and the terms and conditions of these bonds are as follows. The first bond is a 15-year bond that was initially issued in 2019 and now has 8.3 years left to maturity. This bond has a coupon rate of 12.34%. And the second bond is a 20-year bond that was initially issued in 2021 and now has 15.3 years left to maturity. And this bond has a coupon rate of 13.44%. Please note that these bonds are now open for sale until Wednesday, the 20th of May, when the auction will be held. In the corporate bond market, the Kenya Mortgage Refinance Company has achieved a major financial milestone with the second tranche of its inaugural green bond attracting bids worth 9.4 billion shillings against an initial target of 3 billion shillings. This massive oversubscription of 312% successfully defied the absence of a tax-free sweetener for investors. The 8-year paper, priced at 12.20%, was on offer between the 28th of April and the 12th of May 2026. Following this highly successful issuance, the bond is now earmarked for listing on the Nairobi Securities Exchange on the 25th of May 2026. This issuance marks the second tranche of a broader 10.5 billion shilling bond program and comes 4 years after the company's debut corporate bond issuance in February 2022, which raised 1.4 billion shillings and drew a 480% oversubscription. This new green bond features a 5.1-year average weighted duration or tenor, and this design ensures that the bond holders will receive a principal amount paid down gradually over time as opposed to receiving a single lump sum bullet repayment at maturity. The billions raised from this green bond are expected to provide a substantial boost to the company's rapidly growing loan book, which closed 2025 at 19.6 billion shillings. The Kenya Mortgage Refinance Company will deploy this newly acquired capital to provide cheap and accessible loans specifically tailored for green buildings. These eco-friendly structures are strategically designed to use natural and sustainable materials and to optimize energy efficiency and reduce water consumption in a concerted effort to minimize environmental impact. At the Nairobi Securities Exchange, during the past week, the equities market was on a downward trajectory with the NASI declining the most by 1.9%, whilst the NSE 10 declined the least by just 0.1%. This takes a year-to-date performance to gains of 12.2% for the NSE 20, 11% for the NSE 25, 9.7% for the NASI, and 8.6% for the NSE 10. The weekly performance of the stock market was mainly driven by losses recorded by large cap stocks such as British American Tobacco, Safaricom, and East African Breweries, which declined by 9.8%, 6.7%, and 0.8% respectively. However, this performance was supported by gains recorded by other large cap stocks such as Cooperative Bank, Standard Chartered Bank, and Absa Bank, which increased in value by 10.5%, 2.9%, and 2.3% respectively. And in related news, the Nairobi Securities Exchange has experienced a significant revitalization in retail market participation following the launch of Safaricom's M-Pesa trading platform, better known as Ziidi Trader. This innovative platform allows M-Pesa users to directly buy shares on the exchange without the traditional requirements of opening a standard brokerage account. New disclosures from Safaricom reveals that approximately 511,000 retail investors have signed up for this service. And within just 2 months of its launch, that is between February and March this year, about 84,000 retail investors have actively used their Ziidi Trader accounts to purchase shares on the exchange. While these figures highlight a surge of initial interest from retail investors, they also indicate that only a fraction of those who signed up are actively engaged in trading. Furthermore, the number of active traders on the M-Pesa platform still trails the broader market, where individual investor accounts with the Central Depository and Settlement Corporation stood at 1.28 million accounts by the end of March 2026. Despite being in its early stages, additional data from the exchange covering the period from the 10th of February up to the 6th of May shows that Ziidi Trader successfully facilitated over 268,000 transactions valued at 772 million shillings. During this period, the platform's share of overall market activity fluctuated between 1 and 2%, establishing a steady average of 1.67% of total market trades. Up next is our topical issue, and this week we're looking at the Kenya Revenue Authority seeking the identity of crypto traders in order to curb tax evasion. The Kenya Revenue Authority is pushing for stricter oversight on digital assets to ensure investors cannot hide their financial gains from the tax authority. Under proposed amendments contained in the Finance Bill 2026, cryptocurrency exchanges and platforms will face mandatory reporting requirements, and that is if members of parliament back the proposed legislation. This policy aims to make it significantly harder for digital asset investors to conceal their profits from holding or trading crypto. If the bill passes, virtual asset service providers will be legally obligated to disclose the full transaction records and identities of their Kenyan customers through annual filings directly to the Kenya Revenue Authority. These comprehensive data disclosures are designed to give the taxman complete visibility into domestic crypto transactions. The annual returns will require crypto exchanges to hand over detailed transaction histories, and this includes tracking how much investors originally paid to acquire their digital assets, as well as the final amounts received when selling them, and any specific profits realized from these transactions. Furthermore, the reporting mandate will extend to individuals who are actively using cryptocurrencies as a medium of exchange for the payment of goods and services. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if that is the case, please share this podcast with your family and friends and help to keep them informed of the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. And for more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major distribution channels such as Apple Podcasts, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamuhuri@gmail.com. Jamuhuri spelled JAMUHURI. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, if there is no struggle, there is no progress. A quote by Frederick Douglass. Think about it. Thank you, and God bless.